Ever picked up a bargain appliance or a trendy jacket only to have a critical piece shatter 6 months later? You throw it away, head back to the store, and buy the exact same thing again. We are taught that scanning the aisles for the absolute lowest price makes us financially responsible. We balance the budget, pick the cheapest option, and feel like we made a smart choice. But that instinct to grab the cheapest box on the shelf actually triggers a hidden, persistent penalty known as the replacement tax. Manufacturers know exactly how long these cheap components will hold up. They engineer them to fail on a schedule, forcing you into an endless loop of repurchasing. By trying to save $20 today, you are walking directly into a trap engineered to siphon away your disposable income year after year. To calculate exactly how fast this drains a bank account, we look at the Boots theory of socioeconomic unfairness. This diagram shows a 10-year timeline. Let's say consumer A buys a poorly made pair of work boots for $100. Because the materials are subpar, the soles split in exactly 12 months. They have to go back to the store and buy another $100 pair every single winter. Over a decade, they spent $1,000 in total, and their feet are still soaking wet by February. Meanwhile, consumer B spends $300 upfront on a pair of high-quality, double-stitched leather boots. They take care of them, and those boots last the full decade. Compare the two totals here. The person trying to save money upfront paid a $700 premium. That mathematical gap is the replacement tax. You can apply this exact calculation to your smartphone, your washing machine, or your office chair. The initial sticker price on the shelf is an illusion. Your actual cost is determined by the number of times you are forced to swipe your credit card for the exact same utility over your lifetime. So why does a modern washing machine tear itself apart in 4 years, when your grandparents' model ran for 3 decades? In the early 20th century, manufacturers realized a flaw in mass production. If they built a car or a refrigerator that never broke down, everyone would eventually own one. Sales would stop entirely, and the factories would go bankrupt. Their solution was planned obsolescence. They began intentionally designing weak points into their products to guarantee future sales. Fast fashion brands weave polyester blends engineered to pill and unravel after 5 washes. Modern appliances use fragile digital control boards, timed to short out shortly after the warranty expires, a far cry from the heavy mechanical components of older models. Manufacturers intentionally time these failures to maximize recurring profit, ensuring the product breaks exactly when the corporate bottom line needs a boost. Buying cheap, disposable goods leaves the consumer in a state of permanent rental, paying repeatedly for garbage that never truly stays in their possession. Escaping this cycle requires adopting the buy-it-for-life philosophy. Stop looking at the price tag and prioritize repairability and heavy-duty materials. This means fighting your own psychological wiring at the cash register. It requires accepting a higher upfront cost today to avoid a predictable, heavy premium tomorrow. Look at this chart comparing long-term spending. The initial output for the quality item is high, but the cost over time completely flatlines. You lock in your expense, protecting your long-term capital from inflation and forced repurchases. By demanding solid wood, thick leather, and modular parts, you stop subsidizing the landfill economy. High-quality goods are a strict mathematical necessity for anyone looking to protect their capital and permanently escape the corporate replacement tax.